Hey everyone, welcome back. Ready to dive into a topic that's, well, let's be honest, not always the most thrilling, but is absolutely crucial to understand. We're talking about investment risks.
That's right, because let's face it, we all want our money to grow, but none of us want to lose sleep over it, right?
Exactly. So today, we're arming you with the knowledge to navigate those choppy financial waters with hopefully a little more confidence than before. And to guide us on this deep dive, we have a great excerpt we're going to be breaking down called Investment Risks.
And it's a really interesting one. This excerpt dives into 5 major types of risks that every investor should understand. We're talking about inflation risk, liquidity risk, credit risk, market risk, and of course, interest rate risk.
And I think a lot of times these risks can feel kind of like abstract concepts, something you read about in a textbook. So our goal today is to really bring them to life with like real world examples so you can actually see how these risks might pop up in your own investing journey.
Sound great. Let's do it.
Awesome. So let's kick things off with inflation risk because let's face it, it's been rearing its head a lot lately. What exactly do we mean when we talk about inflation risk when it comes to our investments?
Well, think of it this way. Every dollar you have today buys you a certain amount of goods and services, right? But inflation slowly chips away at that purchasing power over time. Imagine saving up for that dream vacation in, say, 5 years. You've got it all budgeted out based on today's prices. But because of inflation, the cost of flights, hotels, you name it, has increased faster than your savings have grown. Suddenly, your dream vacation just got pricier.
Ouch. And that's inflation quietly eating away at your savings. So what can we actually do to fight back against this sneaky enemy?
That's where strategic investing comes in. We want our money to grow at a rate that outpaces inflation, so we're actually getting ahead.
Okay, so we're not just trying to keep up with inflation. We're trying to outrun it. That makes a lot of sense. Now, that actually ties in nicely with our next topic, liquidity risk. Because what good is an investment if you can't access your money when you need it?
Exactly. Liquidity is about how quickly and easily you can turn an investment back into cash without taking a loss. Let's say you've invested in a rental property. Sounds great for long-term growth, but what if you suddenly need a large chunk of money and the only way to get it is by selling that property quickly? You might be forced to accept a lower price than it's actually worth just to make a fast sale. Compare that to, say, a high-yield savings account where you can access your money at any time without penalties. Right, so there's always a trade-off, like greater potential for growth often means less liquidity. So I guess the key takeaway here is to really think about your own time horizon and financial needs before jumping into an investment.
Absolutely. And that's something I see people trip up on all the time. They get caught up in the excitement of potential returns and forget to consider when they might need that money back in their pocket.
Okay, that's super important to keep in mind. So we've covered inflation risk, liquidity risk. Let's move on to one that honestly sounds a little scary, credit risk. Break this one down for us.
Sure, credit risk boils down to this. Will someone you've loaned money to actually pay you back? A common example is investing in a company's bonds. Essentially, you're loaning them money with the promise of interest payments and eventually getting your principal back. But if that company goes belly up,
That money's gone. So how do we avoid falling into that trap? How can we be smart about assessing and mitigating this credit risk?
it all comes down to due diligence. Research, research, research. Before you invest in a company's bonds, dig into their financials. How much debt are they already carrying? What's their track record like? Diversifying your investments can also spread out the risk.
Don't put all your eggs in one basket. That's
Yeah.
a classic piece of advice for a reason. Okay, up next we have market risk. This one feels pretty broad. Fill us in.
It is broad. Market risk is all about those big picture economic swings that can affect the entire market, stocks, bonds, you name it. We're talking about things like recessions, unexpected geopolitical events, major shifts in interest rates. Even if you've made solid individual investment choices, a sudden market downturn can still impact your portfolio's value.
So it's kind of like being on a roller coaster. Even if you pick the sturdiest car, you're still in for the ride's ups and downs.
Exactly.
Okay, last but definitely not least, let's talk about interest rate risk. What do we need to know about this one?
Interest rate risk is particularly relevant for fixed income investments, like bonds. Let's say you buy a bond that's offering a 3% return. Seems decent, right? But then imagine that interest rates in general start to rise, and now investors can get a 5% return on newly issued bonds. Your 3% bond suddenly looks a lot less appealing, which can drive its price down.
So in a way, it's like your investment is competing with all these other investments out there. And when interest rates climb, it can make certain investments less attractive. So what's the key takeaway for our listeners?
The diversification is key. Instead of putting all your money in just bonds, spreading it across different asset classes like real estate, stocks, and bonds can help cushion the blow if interest rates rise.
That's incredibly helpful. Now, what I'm realizing as we're talking about all of this is that these risks are all kind of like intertwined. It's not like they exist in their own little bubbles. They influence each other in all these interesting ways.
You're absolutely right. It's like a complex web. Think back to what we were discussing earlier about inflation. When inflation starts to rise quickly, what do central banks typically do? They raise interest rates to try and cool down the economy.
Right. So suddenly, inflation risk is directly influencing interest rate risk. And I bet this also plays into market risk as well, right?
Absolutely. Higher interest rates can make borrowing more expensive for companies, which can slow down economic growth, leading to...
A market downturn, it's like a domino effect.
Yeah.
And I bet liquidity comes into play here too, right? Like if there's a sudden market drop because of, say, some unexpected global event, and everyone panics and tries to sell their investments at the same time.
Exactly. You get what's called a liquidity crunch. Prices drop rapidly because everyone's trying to sell, and it becomes really tough to offload investments quickly without taking a significant loss. So yeah, it's all interconnected in really fascinating ways.
It's like this whole intricate dance between all these different factors. Wow. So for everyone listening, as you're thinking about your own investment approach in your own portfolio, which of these risks resonates most strongly with you right now? And what questions does this spark for you as you're thinking about your own financial goals? We'd love to hear your thoughts.
And don't forget, while understanding these different types of investment risk is absolutely crucial, it's also essential to understand your own personal risk tolerance. How much volatility are you comfortable with in your portfolio? That's a question every investor needs to ask themselves.
That's such a good point. Investing isn't just about numbers. It's about how those numbers make you feel. And on that note, we've reached the end of our deep dive into investment risks. But remember, this is just the beginning of the conversation. Keep asking questions, keep learning. And as always, if you're ever unsure about anything, don't hesitate to reach out to a financial advisor for personalized guidance. Until next time, happy investing.